This idea just keeps on bouncing back into my mind. I think it originally hit in 2016. I've researched it multiple times. And unfortunately, I'm not in a position to take advantage of this opportunity, but you might be. So I'm going to share it with you, and it's just useful knowledge or ways of thinking about debt, investment returns. It'll be some good insight. So you're going to need three things to make this happen. Up first, you're going to need a home, and you're going to want that home paid off, or little to nothing left on the mortgage. The second thing you're going to need is a good credit rating, and the higher the better. The third thing you're going to want is a steady stream of income that you can use to pay off a loan that you'd take out. So with interest rates at all-time lows, you can take out an extremely cheap loan with your home as collateral. These are they're called home equity lines of credit, heloc for short. And many borrowers will use them for home improvement projects like updating a kitchen or a bathroom. Although big lenders, some of the big banks, they don't require you to put that loan in any specific thing. You could just turn around and invest the money. That's the big idea in a nutshell. Now, I want to make it clear it's not a risk-free opportunity, but as you're about to see, the risk to reward opportunity is, if I was in the position, this is something I would definitely do. And also later on, it's not true, well, at least starting out, this is not arbitrage or pure arbitrage, but after 10 years, 15 years, you wouldn't need to put any additional money down. Essentially, it works itself out with money that you'd collect and money going out the door. Okay, so I'm going to walk you through a quick spreadsheet I put together so you can get a very clear picture of how this strategy works. And before we do that, I'd really appreciate it if you just tap the like button as well as subscribe. Okay, let's dive in. All right, let me zoom in here, make it a little bit easier for you to see. All right, so to make it simple, let's start with a $100,000 home equity line of credit. Homes are on average worth more in the US, and to get the best rates, you want to take out a lower percentage of your actual home's worth. Now, to figure out the fixed 30-year rate that we'll use for these calculations, we'll jump to the Federal Reserve Economic Database. 30-year fixed rate mortgage average in the US sits at 2.87%. Now, this is the average. So if you have assets at a bank and are a bigger customer, they might give you some basis point discounts when taking out loans. And if you have great credit rating, this might drop as well. So you might be able to lock in a 2.6% fixed rate. But to play it on the safe side, we're going to go ahead and just use 2.9%. So just slightly above the average in the US. Now, what would your average monthly fixed payment be? So we can use the PMT function. The rate is the 2.9%, which is annual, so we'll divide that by 12 because they are monthly payments. The number of periods is going to be 12 months times 30 years. And then the last variable we need is the present value of the loan, $100,000. So based on this, you're going to be making fixed payments of $416. Now, as I mentioned, one of the things you need to really make this plan work is steady income. You need to make sure you're able to meet this payment through the first 10 plus years. I'll show you a little cool trick later. And to look at the total amount paid over the 30 years, that fixed payment times 12 months in a year times 30 years, you're going to pay back the $100,000 principal, as well as close to $50,000 in interest over that time frame. Now, looking at the next variables I have for you, or I guess how you invest the money, we'll go ahead and link it to the amount you take out. So you turn around and instead of using or doing a home improvement plan, you take that $100,000 and you can invest it in a broad-based stock fund. And the average annual return of the stock market is, you'll see 8 to 10% figures used often, but I'll use 5% just to be a little more conservative. I like to really bake in some wider margins of safety with these plans. So your investment in 30 years, what would it be worth at the end of this loan agreement? So your initial investment of $100,000 times 1 plus that annual rate. plus 5%. And then that raised to 30 years is going to give you $432,000 in return. And just to show you the power of compounding and small numbers, how they really impact longer term outcome, let's say this was the 8% return. Your $100,000 would turn into over $1 million in 30 years at 8%. But once again, we'll stick with the lower 5% just to play it a little safer. And now with this strategy, it's really, really important to consider short-term volatility. In any year, 3 years, 5 years, the stock market might be down. So you need to make sure you don't have to tap into this investment, and you can meet these payments based on other cash flows or income that you have. If you were forced to sell part of this investment in any given year, it would really hurt the viability or the beneficial outcome of this strategy. So that's also why I really recommend having large emergency funds, also good health insurance. You don't want a big health cost to come up and then you'd have to close out of this early at a loss. You need it working for you in the long term. Zooming out a little bit here. Now, one of the huge benefits of this strategy is that, okay, so you have to pay $416 every month. But if you invest in a dividend fund, you're going to collect some income over this time frame, and that can help offset that payment. So let's say you can find a fund that pays 3%, which actually is quite easy to do. There's some funds out there that pay more. Your starting monthly dividends is going to be your initial investment times that rate. So that's what you'd collect each year, but of course we want to see the monthly average. Most of these funds will pay quarterly, but you can simply let it pool up in a bank account and then use that to help make the monthly payments. So investing it in one of these funds, you're going to get on average $250 a month starting out. So that pays more than half of the monthly fixed payment, which is amazing. One of the big benefits though is dividend payments of these funds, or the market as a whole, as the economy expands. Of course, there's short-term downturns, but if you're looking 10 plus years, you'll see growth in dividend payments. And over the last about 13 years in some big funds, to incorporate the last downturn, we've seen just over 6%, not 600%, just over a 6% annual dividend growth. So your monthly dividend in 10 years is going to grow from $250 to raised to 10 years is $447. So if you're able to stick out this plan for just 10 years and the average annual dividend growth increases at 6% annually, once again, of course, in the short term, it's going to be volatile. This year, we're going to see a downturn, a little bit of a negative growth, but over the subsequent recovery years, it should probably average that rate. The dividend payment alone in 10 years more than pays for the monthly fixed loan. So at this point, it's really a pure arbitrage situation. You don't really have to put any more money down. You just turn around and let those dividend payments pool in an account, and then from that account, you can have the automatic loan payments. And once again, this is just 10 years. If we went to 20 years and that average annual dividend growth continued, we're going to go ahead and bump this up to 20 years. It'd be about $800 monthly in dividends that you receive. But yet 20 years prior, you would have locked into paying $416. So even with some variability, in 20 years, you should be able to easily offset that monthly payment, and the rest is just gravy. You get to keep on collecting bigger dividends, and also you'll see capital appreciation with that dividend fund. So in a nutshell, this is the plan that I'm super excited about. Just unfortunately, I'm not in the situation to be able to leverage it. But if you are, it might be something you want to consider. There are also some tax considerations and a few things that I've looked into as well, but each situation is different. And with all that variability, I'm not going to get into that here. Either way, if you want to see more, go ahead and just leave a comment down below. And once again, I'd really appreciate it if you tap the like button as well as subscribe. Thank you.